And Dave, let's kick off this very busy Tuesday morning. You're down at the Four Seasons here in Hong Kong at the UBS Asian Investment Conference. Tell us what's on tap.
Yeah, well, well, I know this is an overused term. It's interesting in a sense that it doesn't feel like a banking conference. It really feels almost like a tech conference. Just looking at really the people that are here. Certainly there is an investment sort of theme that underscores all these technology conversations around AI, Gen AI, technology, longevity, sustainability. You know, if the name of the conference, by the way, forget it, if the name of the conference sounds familiar, it's probably because it is, right? So Credit Suisse, this was their flagship conference for 27 years, up until quite literally this time last year, going into the 2023 Asian Investment Conference. And then the takeover took place, of course, from UBS and UBS to Credit Suisse, and of course over that weekend. And I remember it vividly. We didn't know, we were actually going to attend the conference and we didn't know if the conference was still going to take place. I'm sorry if I'm just taking a step back in history, but that sort of lays the foundation of where we are, that UBS is now taking this conference and taking it forward. In fact, you know, I was speaking with earlier the UBS Asia Pacific president, Edmund Koh, and you know his analogy, his example was, it's like like a true wealth bank says, right? It's like an inheritance. You take it and you try and make it better. So we spoke with already quite a few number of people, including the Edmund Koh, of course, the president of Asia Pacific at UBS. So we touched on a lot of things, right? We touched on what this conference means. We talked about what is in store. We're just starting with that. You can hear the sound behind me. And also where they are as far as these job cuts are concerned. We talked about that. And also we had an interesting conversation shortly after that on AI with the co-founder of Chinese AI firm SenseTime. So have a listen.
We have seen top-line growth quite strongly, as well as our discipline on cost. We've optimized most of the position, both in terms of lines of business and the geography as well. We are in 13 locations in Asia Pacific. For most of that, we are done.
There are shortage of resource here in Asia in general. For instance, the shortage of compute. I think in general it's like a 10 times of gap of the compute resources that we have here compared to the US leaders. But I think Asian markets never lack of talents and never lack of data. So in terms of talents and data, I think eventually we will also be able to, even though that we have lack of compute, we're able to, make sure that we squeeze the last bit of the compute.
Yeah, so we have a lot more interviews coming up here on the ground. I guess just to get us started, the ones that are coming up this hour, to be more specific, are actually quite topical. So we're talking all things geopolitics, this complex relationship between the U.S. And China. So we're joined by Dennis Wilder. He's a Georgetown university professor, former CIE Deputy Assistant Director for East Asia. He's actually just right next to me. We're going to get him seated in a couple of minutes. He has some interesting insights really on particularly AI. Like there are actually overlaps that the U.S. and China can sort of work together on. And to talk us through equity markets, UBS Chief Global Equity Strategist Andrew Garthwaite will be joining us, of course, at the bottom of this hour. Plus, of course, we'll be having really a deep dive into all things macroeconomics. As you can see on your screens, those two names should be household names to you, all things macro, with Olivier Blanchard and the former RBI Governor, Raghuram Rajan. Steve.
Pretty light day for you, Dave, down at the UBS conference. We'll be right back with Dave real quick. We want to get a quick market check. Obviously, there's some narrow trading in early Tuesday morning here in the markets across the Asia Pacific, awaiting some very key inflation prints on global markets around the world. Let's get over to Avril Hong in Singapore for a quick market check. Avril, good morning.
Hey, good morning, Stephen. Yeah, we're seeing markets in the Asia Pacific so far in wait-and-see mode. I think the event of the week in terms of data is going to be the Fed's preferred gauge of inflation on Friday. In the meantime, you can see it's mostly sideways on the stock benchmarks. Now, we did get some scene setting from the European side of things. One governing council member of the ECB not ruling out those consecutive rate cuts. Remember, June is mostly penciled in for the ECB. July July is the big question. So we saw Asia, or rather those European shares running higher, and the euro dropping to a 9-month low earlier against the pound. Some recovery there now. Across Japan assets, it seems to be that penciling in of the BOJ's normalization of monetary policy potentially accelerating, especially in light of what we got from the BOJ officials yesterday. Some of the comments in that direction. Let's flip the board because I wanted to take you through what we're seeing among chip stocks. Yesterday, of course, we saw that afternoon session surge in Chinese equities after the largest ever chip investment fund was unveiled, and that provided that lift, I think, for the domestic Chinese chip-related stocks. Today, this is what we're seeing across their other Asian peers. But flip the board, I also want to take you to how we're setting up in China. The state lenders have been tapped on for this chip investment fund. And of course, we're also getting other lines from the Politburo meeting, Xi saying that the financial regulations need to have more teeth. What is this going to mean for the bank's lending standards? Is this going to be more tightening in a way? Still, we're seeing potentially a positive open. Keep in mind also that we're seeing those property easing measures spreading to top-tier cities such as Shanghai as well, Steve.
All right, thanks a lot, Avril Hong in Singapore, keeping us up to date on how the markets are opening up here in Asia on this Tuesday morning. Now, here's the agenda for Greater China. Chip stocks, as Avril just alluded to, are in focus as China sets up a $48 billion fund to develop its local industry. Property as well, with Shanghai relaxing some home purchase rules. That will be in focus. And keep an eye on the Bloomberg China Economic Survey. Alibaba Health earnings due later in the day, and hotel occupancy numbers out of Macau. Plus, in Hong Kong, Chief Executive John Lee. He'll be holding his weekly news conference. More now on China setting up its largest ever semiconductor investment fund. Dave, you did talk to SenseTime Xu Bing a little bit about how China is catching up fairly quickly with the U.S. on AI chips. I mean, did he have something particular to say that how China is catching up?
They did. In fact, what's interesting is, so they're a 10-year-old company. They went public 2-3 years back. And, one of the first things he actually told us was NVIDIA was a very big part of their growth story. In fact, they invested a lot in NVIDIA chips. So, my mind immediately went to the fact that, okay, so now that you have these restrictions coming up, how are you guys working around this, and what are the sort of other options, alternatives that you have? If in fact the Chinese AI sector, for example, runs up against a specific, well, he said, don't worry. There's a lot of development taking place within the Chinese chip industry, for example. There are domestic alternatives. He didn't give specific details of what those alternatives were, but he didn't seem particularly concerned over the longer-term prospects of not being able to access that technology or capital. But again, Steve, back to the point of this, I think it's big fund number 3, if I'm not mistaken. How significant, in your view, because you've covered this too, do you think this one is? It's about $50 billion, if I'm not mistaken, U.S. dollars.
Yeah, it's about $48 billion. It is called Big Fund 3. There have been hiccups in the past, and the big leaders in China have been frustrated, to say the least, about not being able to catch up with the advanced technology on chips in the United States. So this is Big Fund 3. They're throwing more money at it. We'll have to see. I mean, there were corruption allegations to the previous big funds, so we'll have to see how this pans out. But clearly, it is a top priority. Now, Dave, we're also kind of looking at this other story coming out of Beijing with Xi Jinping essentially Monday meeting with the Politburo, the 24 top leaders in China. Also, he had a separate meeting with the Central Committee to talk about other risks. But essentially, that Politburo meeting was making local governments and regulators accountable for their financial health across the nation. And that is a key thing that is going forward as they're trying to deal with a slowing economy. And also, it kind of dovetails with previous efforts by Xi Jinping to root out corruption and making sure that, the finances are going to the right place. He basically, according to the Xinhua news agency, Dave, details of these new rules that they are announcing to basically hold these officials more accountable for containing financial risks. Details were not disclosed, but Xinhua said they will send a powerful signal, quote unquote, for holding officials accountable and making sure financial regulators and regulations have teeth. So there will be accountability to those officials. And also, of course, at the National People's Congress, Dave, when I was there in March, the annual session of Parliament, they did talk extensively about the hidden dangers in the Chinese economy. All right. Well, Dave, still ahead, tensions between China and the U.S. are ratcheting up over technology and trade. We'll take the temperature with Georgetown professor Dennis Wilder. He is a former CIA Deputy Assistant Director of East Asia. He joins us next from the UBS Asian Investment Conference with, of course, David Ingles here in Hong Kong. This is Bloomberg. And welcome back to the China Show. I'm Stephen Engle. Now, let's look at some of the top stories we will be following throughout the morning. North Korean state media saying a rocket meant to put a reconnaissance satellite into orbit has exploded in midair. Video provided by South Korea's military is said to show the rocket breaking up in a fireball after its launch on Monday evening. It is a setback for leader Kim Jong-un, who went to Russia last year seeking help to place an array of spy satellites into orbit. Meanwhile, Beijing is accusing the Group of 7 nations of hyping the threat of Chinese overcapacity. On Saturday, the bloc finance ministers and central bankers said China was hurting the economies of its trade partners. Beijing has said, again, dismissing those claims, with the foreign ministry saying the G7's complaints amount to protectionism. It's the latest display of mounting tensions between China and the West. And U.S. lawmakers visiting Taiwan have expressed support for the island's defense and say Washington has to provide deterrence. They're the first American politicians to meet Taiwanese President Lai Ching-te since his inauguration just a week ago, last Monday. Their visit comes just days after China wrapped up its largest military drills for 2 days, largest drills in a year, around Taiwan, of course. All right, we're going to get back to the UBS Asian Investment Conference, where our stalwart there, David Ingles, is manning the fort. Dave.
Yeah. Here at we're really roughing it here at the Four Seasons, Steve, and I certainly hope you guys are well and safe there in our studios, a couple of 100 meters from where we are. That's banter, of course. You mentioned Taiwan. It's one of the things me and our next guest, of course, just talked about during the break. So joining us here, in fact, on set is Dennis Wilder, Georgetown University professor and former CIA Deputy Assistant Director for East Asia and the Pacific. Dennis, good morning, and thank you for joining us.
Thank you. Great to be with you.
Taiwan, quite timely. We'll get to that in a moment. Yeah. Let's set the stage. We're coming off some pretty high-profile visits, high-level visits.
Right.
Secretary Yellen was in Beijing.
Sure.
You had Antony Blinken there as well.
Absolutely.
Is this relationship, while complex, as stable as one can reasonably hope?
I think it is. I would call it uncomfortable coexistence. I think we're going to have strategic competition for a great length of time over things like technology, values, global South, economic, political. We are in a long-term strategic competition with the Chinese, and it's inevitable. The two greatest economic powers in the world, now really the two great military powers in the world, we inevitably are in this position. But that doesn't mean war. And I think Americans are very clear, American military leaders, American political leaders, we're not looking for war with China. But we do compete, and our values are different, and we do have different ideologies, and that is just a reality that we're all going to have to live with.
That takes us into the Taiwan conversation. You mentioned war. The U.S. has said it's not interested in war. The Chinese have also said it's not something they want.
Right.
Why do we keep talking about it then?
Because there is a danger here. And the danger is that if Beijing were to ever feel that peaceful unification is impossible, then the political leadership in Beijing would be under pressure to do something about this situation. I do worry that William Lai, in his inaugural address, went too far. I think he provoked Beijing a little bit. The fact that he did not say that negotiations would be under the principle of the Republic of China Constitution was a dangerous thing to say, because it gets away from the one China concept. So I worry that we are in a little more tense period, that Beijing and Washington are going to have to carefully manage William Lai. Washington can't love Taiwan too much. There is a danger with all of these congressmen and senators loving Taiwan that the leadership in Taiwan might get the sense that they can move further, and I think that's very dangerous. The status quo is wonderful. My president, when I served him, George Bush, established the principle of unilateral changes to the status quo by either side. I think that's the perfect position. Taiwan gets a certain degree of independence. Beijing is assured that the United States isn't going to support independence. I think that's where we want to be.
If I remember correctly, it takes me into Donald Trump, possibly a 2.0. One of the first calls he took during his first few days in office was from the then Taiwan president, Taiwan. Yeah. What does that look like for these relations, for the status quo as you laid it out?
I think there's some danger. I noticed that former Secretary Pompeo is in Taiwan a lot. I wonder what he is saying to the government on Taiwan about what would happen in a Trump administration. I think personally Trump actually is not that engaged on the Taiwan question. I see Trump trying to make a deal with the Chinese over trade, actually. I think he's got this whole plan of 60% tariffs is really a way to stimulate the Chinese into talks. And I think we would actually find that Trump and Xi Jinping end up with a fairly good relationship.
Is there room for an improvement in relations going into elections, which is let's call it 5-6 months away?
No. In fact, it goes the other direction. If you look, what Biden right now is focused on is Wisconsin, Michigan, and Pennsylvania. And all the anti-China steps that have been taken recently on tariffs, on EVs, it's all about those states. If Biden is going to win, he has to take those 3 states. My friend Charlie Cook, who's here as well, makes that case. The only way Biden wins is through those 3 swing states. So he is doing everything possible to galvanize and get out the union vote. And that's an anti-China vote. And so that's why you're seeing these steps, and I would anticipate more of them before the election.
What do you expect from the Chinese side? They probably know, they likely know this is all political noise domestically in the U.S.
They absolutely understand what's going on. They're not going to overreact because it's politics.
They'll want to make a point, though.
They will want to make a point, and we're going to see them do some things. We've already seen them threaten a few things. I think they'll have to, in part, to keep the Europeans from doing some of these things. Remember, on the EVs, there's the whole issue of Europe now and what steps Europe might take. So I think the Chinese, to scare the Europeans off a little bit, we're going to see them take some retaliatory steps.
What does this mean for businesses? Certainly the cost of doing business has gone up. China plus one, reshoring, de-risking.
Right.
Companies are sometimes willing to make that investment if there is certainty ahead, if they can make that investment back.
Yeah.
Does the level of uncertainty even get worse from here, or do you see things as bad as they can possibly get?
I think a little more uncertainty. One of the problems is that on emerging technologies, the administration is going to keep looking at these and keep ratcheting up. We're not at the end, because the thing about emerging technologies is they continue to move. And the administration is going to have to make decisions on new technologies and how much to restrict those. And so the small yard, high fence is going to get bigger. The yard's going to get bigger. The fence is going to get higher. That is an inevitability just because of the nature of technology.
And for those companies that rely on China, whether as an end market, as a part of their supply chain, China's maintained and said it's open for business.
Absolutely.
It says, come in, we welcome foreign investment. That foreign investment has trickled through. It's not pre-pandemic levels just yet. What do you make of the messaging coming out of Beijing? What do you think they need to do to get that message across? Because there seems to be also this information, this asymmetry, this gap in between.
The difficulty in Beijing right now is that there is this emphasis on national security. They had this problem with Qingang. I believe Qingang was an espionage case. I think that scared Beijing, and you can see that the MSS has been allowed to do much more publicly than it had before. So there's this tension between national security and wanting the West to come in. And it's going to be interesting to see how Beijing navigates that. I'm very interested, obviously, in the third plenum coming up, what that tells us about Chinese economic policies and about the opening to the West.
Dennis, it was a pleasure to have you on the show. We can do this all day. Let's run this back.
All right.
That was Dennis Wilder, their former CIA Deputy Assistant Director for East Asia and the Pacific. He's also, of course, Georgetown University professor. Joining us here at the Four Seasons UBS Asian Investment Conference. Back to you.
And welcome back to the China Show. We're closely watching shares of Semiconductor Manufacturing International and also Hua Hong Semiconductor. Those companies surging on Monday following news that China set up a $47.5 billion chip fund to support the local industry's development or further development. We're also focusing on property developers. Shanghai has lowered the down payment ratios and the minimum mortgage threshold for home buyers. And meanwhile, China Vanke has repaid a dim sum bond that was due on Monday. All right, the market open is coming up next. You're watching The China Show. This is Bloomberg. And welcome back. You are watching The China Show. We're counting down to the open of markets, of course, here in Hong Kong in about 40 seconds, and also mainland China in Shanghai and in Shenzhen. We'll be looking at chip stocks again. SMIC, of course, yesterday gaining about 7.5% here in Hong Kong. This on news, of course, of this Big Fund 3. Xi Jinping and the central leadership in China are throwing more money at developing its own domestic chip industry. Also, Alibaba in focus. Guess who's going to be their new brand ambassador for AliExpress shopping platform globally? David Beckham gets more exposure in the Asia Pacific. And Lenovo up 8.9% yesterday, 9-year high for that stock. Its AI PC outlook given a thumbs up by Goldman Sachs. Let's get over to Avro Hung with how the markets are opening up right now in 1 second.
Yeah, we're just about seeing a flat open on the mainland. Hong Kong, we already saw a bit of that direction coming through. And it is also a pretty sideways trade. Remember, keep in mind, Monday's late session surge showed pretty strong gains on these indices. On the face of it, there are a couple of positives, right? The major Chinese city, Shanghai, easing those property rules. We also have that chip fund kind of fueling sentiment, but that's not really trickling into early trade for the moment. Offshore yuan, of course, is managing to snap that multi-session decline for another day. And this is against the backdrop of yet another stronger than expected yuan fix. Let's flip the board and take a look at what we're seeing among the chip stocks. As you just touched on, SMIC releasing that surge yesterday, along with the likes of Hua Hong. But it also begs the question, what is this chip fund going to mean for some of the consumer names, the Alibabas, for example, that have been making this great push into AI? And here, our colleagues at Bloomberg Intelligence raise a good point. For these chip makers in China to get to the stage where they are, making these advanced chips, it's going to take a lot more years. In the meantime, they're going to have to rely on these chips that, take a longer time and use more energy. So that might not be that much of a tailwind just yet for some of these Chinese tech stocks. So let's flip the board again, because the other thing that we've been digesting is that Politburo meeting, Xi talking about the need for more teeth for these financial regulators. It seems to suggest that we might get tighter lending standards. Remember, these lenders are already under a lot of pressure to provide support to the property sector. What is this going to mean ultimately for their reserve requirement ratios? Are we going to see more cuts? Still, there is a bit of a positive. We're seeing a bit of a bump up on some of them. Flip the board again. Let's talk about the developers in China. As I say, it's about Shanghai easing those restrictions. So there is a bit of that tailwind coming through in these Chinese property names, the gauge of them also rising. And don't forget, we also had the likes of Vanke managing to transfer those funds to make its dim sum bonds. And this is the major developer, one of those that has not yet defaulted. So it looks like it'll stay that way. Over to you, Dave.
Yeah, well, at least it's a good news story, isn't it? With the Shanghai news, and we'll see. I mean, just to chime in on that price move in property developers right now, right? So from the bottom, some of these names are up 100%. Right, so we've seen that come down a little bit. There's really not a normal day in Chinese property, really, whether that's in the equity markets or high yield, if you think about it. In any case, of course, let's move on, shall we? Of course, we're back here at the UBS Asian Investment Conference to talk us through macro strategy, equity markets specifically. We're joined here on set, Andrew Garthwaite, Chief Global Equity Strategist at UBS. It's nice to see you. Good morning.
Well, good morning.
I don't know. Where do you want to start? Well, equities have done exceptionally well, would you say, given the...
I think better than about 90% of people expected, absolutely,
okay.
Yes.
Why do you think that's the case?
Well, I think really three things have happened which weren't expected, at least the last day I see. I mean, first of all, a year ago people were saying very high probability of a recession. Instead, US growth was 3% year on year. Why was that? Because you had such huge fiscal stimulus and excess savings. Now 85% of those excess savings have been run down. I think the second factor which helped was the upgrade to earnings. And I think people were underestimating the rebound in what we call Tech Plus.
Yep.
So year on year, EPS growth in Tech Plus is now up 42%. And I think the third factor, which certainly surprised, I think, most humble people in credit teams, was the fall in credit spreads. High yield spreads are really down to their, at 3%, down to their lows of 2021. Yeah. Well, there is a spread, and we can come back to that.
Yeah.
And otherwise, you have to go back to pre-GFC, and the credit spread is important determinant of where the equity risk premium should be.
Right.
But to answer your question on is there even a spread, I mean, it's interesting. Yes, the spread is low in a historical context, but it's still above the default rate. Matt Mish and his team would highlight the default rate's 1.5%, so the spread is free. And there's some interesting data UBS inherited from Credit Suisse, which is a Dimpson Marsh yearbook. These are two professors who look at 150 years of data from the Judd Business School in Cambridge. And they highlight that if you look over 100 years, the high-yield default rate has just been 2.2%. Right. And Matt Mish would say the recovery rate is 40. So in theory, nothing is at equilibrium. You actually only probably need a spread of about 1.8% in the very long run to compensate for the true risk of high yield, which is the default rate.
Right. And now the fact that we went from hard landing to soft landing and no landing.
Yes. And
where does how does it inform you of where the spread probably will go over the next 12 months?
Well, I'm not really a credit guy.
Right. But it's an indicator of equity markets, I guess.
Yes,
if you look at that
you're
for the
absolutely
premium.
Right. Equity markets and credit spreads are very tightly correlated, and actually, what we have found is there's a bit of a lead time between credit and equity. Often 4 to 6 months. So if you perhaps recall, in the really dark days of November 08, when things were completely bleak, credit spreads started to rally very strongly, and that preceded the trough in equities, for example, which was obviously in March 09. So credit can lead a bit. At the moment, we're not seeing a decoupling between credit and equities. And our credit team would highlight the default rate being very low, half, as I say, of the high yield spread. Interest cover for high yield still being very high. The fact they've pre-financed at 24 and 25.
Yep.
And also their lead indicator is the CLO spread, and the CLO spread is actually still well behaved. So they don't see any significant rise in spreads. And the relevance of credit spreads to me is not only does it lead equities, but we have something called a warranted risk premium. Where should the equity risk premium be? And that depends on basically credit spreads and economic activity. And if you combine those two factors, the equity risk premium should be a bit below where we are.
Yeah, I guess we were talking during the break. Another way of saying that would be this equity market just learned to live without the Fed needing to cut interest rates. That, you know, when bad news was good news and good news became bad news, we almost flipped the switch on that. Do you think that dynamic continues? In other words, if and when the Fed signals a cut, is that bad news for equity markets?
Yes, it's a very good question. And I don't think you would have found anyone a year ago who would say, well, if the Fed isn't cutting by the extent which had been expected even 6 months ago, where would the equity market be? What's interesting is historically pauses have actually been better than cuts. Now, I think, looking at historical analysis is a bit banal, but nevertheless it can be intuitive. If you X out COVID, then when you've had a pause since 1989, on average of the next year, the market's up 29%. Okay? And actually the market's up 16% since the last pause.
Yep.
When you've had a cut since 89, when that cut has been 75 basis points or more, then 8 months later the market's always been down. So, because obviously sometimes the preconditions for a cut are the preconditions under which growth and earnings are much weaker than expected. So you've got to be, what the market wants to see is, one, a rate cut, obviously, but two, a rate cut working to re-stimulate growth. And so the present discounted value of future earnings are actually go up, not down.
Well, now that we're operating, and we'll talk about some of your changes and your preferences across markets in a moment, but now that we're operating at a higher rate environment, your risk-free rate is higher.
Yeah.
The low on the next cycle in the Fed funds rate is probably higher than the last cycle.
Yeah.
Does that just pull multiples down? You talk about discounting, for example. How should we look at multiples and valuations then in this sort of new regime?
There's sort of two slightly separate issues. One, where is the equity risk premium versus where it should be, and secondly, what I call the late cycle bubble risk. In terms of the first issue, we do something different from, I think, anyone else on the street, as we have our equity risk premiums in DCF. Most people just take a bond yield minus some form of earnings yield.
Okay.
And therefore, most DCF models aren't really a DCF, because if you take a bond yield minus an earnings yield, it's the growth rate less the equity risk premium.
Right.
Anyway, if we take IBIS numbers and consensus economics, the equity risk premium at the moment is 4. That's low. The historical average has been 5.5. And given where credit spreads and economic indicators are, it should be about 4.5. So yes, the equity market would be about 10% expensive.
Okay.
On pure consensus numbers. However, and this is the critical thing, if you believe, as I believe, that Gen AI can push up productivity by 1% from 2028, the equity risk premium actually goes up to about 4.7.
So we're cheap.
So
if it happens.
A little bit cheap.
Okay.
But the critical issue actually is to believe whether or not Gen AI is going to push up productivity. So that's one issue. So the equity risk premium, if you do a DCF, not a simple bond to earnings yield gap, is a little bit cheap. The second issue is whether you believe that there's a risk of what I call entering a late cycle bubble. And I won't go through them, but I can, of course. But we have 6 of the 8 preconditions in place for entering a bubble. And these are sort of, like Nifty 50, TMT, and many of these other occasions. And in those environments, the equity risk premium gets terribly low. Historically, when you have a bubble peak, the equity risk premium falls between 0 and 2%. In other words, the market would go up at least 50% from here. The problem about the bubble thesis is when the bubble bursts, you lose 80%. But the point is, if we're entering a bubble, this is 97, not 99. We're not in a bubble. It's 6 of the 8 preconditions to enter a bubble.
Right, and if Gen AI manages to sort of wipe out some of the 6 of the 8, so I think we jumped into the Excel model a little bit further, so let me just pull us out a little bit right now. Okay, a simple question is, where do I put my money, right? So what are your preferred markets? I understand you've done, you've upgraded Europe. You think China's going to outperform? Just take us through the simple thinking there.
Yeah, I mean, basically, if we're looking at things very simply, and please do attend our presentation later on today by being a customer of UBS. Sort of three areas. First, we do think the US underperforms. So we like bits of emerging markets, Brazil, China, and we prefer now Europe to the US. Secondly, we have a style bias. Like most people, we focus on quality, but particularly small cap in Europe versus large. And thirdly, rather curiously perhaps, we like defensive growth. So those are areas like software, healthcare equipment, transmission and distribution related utilities, industrial gases, European defence. Some cyclical areas we like, European banks, copper, and bits of the European consumer. But we do like defensive growth. So those are the three sort of areas. To answer your question on, the upgrade of Europe, it was pretty straightforward. Europe is trading on a sector-adjusted PE discount of nearly 17% to the US. Now, that discount has only been higher in a European recession, which we don't have, or a Eurozone crisis, which we don't have. And basically, why should Europe re-rate? Well, I think there are three fundamental reasons. One, the growth gap between Europe and the US is going to close. Year-on-year growth has a 2.5 percentage point gap. That gap is closing, and the lead indicators clearly point to that. Secondly, on June the 6th, Europe will start to cut rates, obviously way ahead of the Fed, and the maturity of European debt is much shorter, so 1% off rates adds 1% to GDP growth after a year. Right. And thirdly, I think some of the structural issues in Europe are actually much better than the US. The elephant in the room, the primary budget deficit, which is a budget deficit excluding interest payments, is 1% in Europe. It's nearly 5% in America, and that's got to represent some form of long-term risk. I think the EU Recovery Fund is forcing a bit of reform. You have to do 600 reforms in order to get the money. That helps productivity, and the EU Recovery Fund helps neutralise debt, which in itself brings down the euro breakup risk. I think there's structural factors, interest rate factors and growth differentials which all suggest Europe should re-rate against the US.
Let me pick up on two things you mentioned there, just very quickly if you could.
Of course.
You mentioned the rate cuts in ECB, June 6th. Do we talk about another one? Is it too early to talk about a second cut for the ECB? Because one seems to be on the cards, second is still being debated. And separately on China, is there anything beyond tactical on the China?
Yeah, I mean, our house view is they do continue to cut rates. So we are looking for rates by the end of next year to go to 2.25% in Europe from 4%. They probably will pause after the first one just to see if the wage data, which was a little bit of a negative surprise, does fall. But the negative surprise in the wage data was purely due to Germany and therefore one-off payments. In terms of China, I mean, you're right. When you look at India, I know you didn't ask me, you can turn around and say the structural outlook is fantastic. In a nutshell, GDP per capita in India is where China was in 1962, and China didn't stop growing in 1962. And the problem in China is all sorts of things, leverage, excess in housing, and excess investment, the triple excess: credit, investment, and real estate. And those are complicated issues to address. I think there are ways those issues can be addressed because, for example, China's a net creditor, so the debt is largely domestic. With judicious policy, they can help finance the excess inventory in housing. So John Lamb would highlight to get rid of all the excess inventory in real estate, tier 1, 2, 3 and 4, or to get that down to normal levels, you need, roughly speaking, just under 4 trillion of money to buy up that inventory. Now, yes, that's 13 times greater than what they've announced, but there is a mechanism in place. So until you can see, at least in my mind, them addressing the issue of excess capacity, property affordability, rental yield, mortgage rate being more reasonable, a clear path to clearing up the excess inventory, then the trade in China, I think, has to be more on the tactical than the strategic. But but there is more of a path for them to clear up the excesses now than there was when we reinitiated in early or late January. We reinitiated with an overweight.
Andrew, thank you so much for making the time. By the way, John Lam is also fantastic, I should note there. UBS Chief Global Equity Strategist there, Andrew Garthwaite. Steve, back to you in the studios.
All right, great conversation. That could go even longer. Great TV there with Andrew and David. All right, if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. So if you want more of Andrew and watch it again, go there. You can also send an instant message to our team and our guests about our guests during our live shows. Check it out at TV Go. This is Bloomberg. And welcome back to the China Show. Property stocks are rising in Hong Kong in early trading, as well as in the mainland. That's after Shanghai saying it's relaxing home purchase rules in the latest bid to boost the property sector. Bloomberg Intelligence analyst Christy Hung is with us from Singapore. Christy, what can we expect next on the policy front? First of all, how important are these measures that were announced for Shanghai, the largest commercial city in China? And what's next on the policy front? Any help on home sales?
Right, so for China, for Shanghai in particular, what is more important is the down payment cuts. So first home, 20%, second homes, 30 to 35%. We think that other large cities like Beijing, Shenzhen, they are going to emulate Shanghai's move. And also, you know, with the recent measures, Shanghai, Beijing, as well as Shenzhen, you know, non-residents can actually find an easier path to make home purchase in those cities. We think that these measures are going to divert home demand from China's smaller cities to larger cities. But all these measures being taken into account, I think weak confidence remain a big issue. Confidence towards, you know, people toward their jobs and the home price upside, as well as the completion of pre-sold homes. So even if people have the confidence to buy a home, we think that they would more likely opt for home purchase in the second-hand home market instead of buying new homes from developers.
Well, speaking of developers, the latest poster child, of course, has been China Vanke. We're hearing that, of course, they're doing a number of different asset sales, including a development that was going to house their future headquarters. Is Vanke sort of crawling out of the woods right now, given the recent rescue measures?
Right, so we have the land sales of his, you know, from his headquarter land plot, and also is considering to sell his stakes from GLP. And then on top of that, we have, you know, recent news of, you know, it being able to secure new loans with banks with collaterals. You know, all these are good news. And on top of that, you know, there's been a shares rebound in the equity space that is going to offer better capacity for equity raising as well. So I think these are all going to buy time with a cash buffer for Vanke, and that, you know, is liquidity for 2024 is looking safer than before. But that being said, if the sales downturn is going to persist, it's still facing contract to sell shortfall every month in billions. So that is going to raise question on its liquidity on 2025. There's only so much assets that Vanke can sell to buy time.
Right. All right. Bloomberg Intelligence analyst Christy Hung, thanks so much. And as you see, China Vanke shares up about 1% along with other developers here in Hong Kong. Plenty more ahead. We'll be right back on the China Show. This is Bloomberg. And welcome back to the China Show. A quick check of China markets, including Hong Kong, the CSI 300, the MSCI China Index, the HSI, and the HS Tech. You can see China markets trading down a little bit in Shanghai and Shenzhen. They're down about 0.25%, trying to hold on to the momentum it's had since February 1st. It's up 12.65% since then. But Hang Seng up, led by property shares on those measures in Shanghai, relaxing home sale curbs and mortgage rules. All right. When we come back, that is, we'll talk with rates and inflation with the former IMF chief economist Olivier Blanchard at the UBS Asian Investment Conference in Hong Kong with David Ingles. We'll be right back. This is the China Show, and this is Bloomberg. welcome back to Hour 2 of the China Show. Here's a look at the CSI. Well, you're looking at Shanghai, of course. That's Lujiazui right there and the Oriental Pearl Tower. Let's look at how the CSI 300 index is faring about a half hour into the session. Well, up now, or that's the MSCI China index, up about 0.5%. CSI 300 failing to capitalize on those gains of yesterday, down in the early going and down about 0.25%. Let's check on some of the big movers in the markets with Avril Hong in Singapore. Avril.
If I think in Hong Kong, we're seeing a bit of a better picture compared to stocks on the mainland. These are some of the big movers that are driving what we're seeing on the Hong Kong benchmark, the energy-related names, CNOOC, PetroChina. And this is against the backdrop of oil prices steadying today. But don't forget, it popped above the $83 handle just yesterday. So the energy counters in not just China, but across the Asia-Pacific, mostly seeing gains. But to your point earlier about what we're seeing among the property easing, I think that's sending a strong signal to the market about just how important this sector is for the recovery in China, and that Shanghai relaxation is raising optimism that we're going to see other tier 1 cities following suit. That is providing a bit of a lift for the Chinese developers listed in Hong Kong, but also perhaps that tailwind for Chinese lenders. Don't forget, they were under a lot of pressure to support the real estate sector as well. Now let's flip the board and take you to what else we're seeing in the Asia Pacific. It is that wait and see mode ahead of Friday, where we're going to get the Fed's preferred gauge of inflation. So a lot of sideways here, but there are some outliers. Take a look at the Nikkei, the yields in Japan, and what we're seeing on the yen, flashing red there. This is against the backdrop of those BOJ officials' comments coming in seem to signal that there will be room for rate hikes. We also got some of those comments from the finance chief today. David.
Yeah, that's really good context. It sets us up for this next conversation, Avril. I'm looking at dollar yen, and the range today is, you wouldn't think, by the way, since I'm mentioning this range, which is on the relatively tighter side, you wouldn't think that we've had some commentary coming through out of Mr. Suzuki on the Japanese yen. So we're looking at a high here of 156.95, and took us about, I think, 20 pips down, give or take, which is really great scheme of things. It's really not a lot. In fact, Mary Nicola is joining us right now, also out of Singapore. She's with our MLive team to give us more context here. And Mary, I mean, they're not really telling us anything new, I guess, is one way to put it, but I'm not sure if you have a different take. But it also sets us up, I guess they're trying to ring fence any potential moves in the event we get something nasty out of core PCE this week.
Yeah, essentially a lot of the comments out of Suzuki were nothing new. But what we've seen over the last month is, the yen has weakened against a lot of its G10 peers, and that still has a lot to do with the fact that you still don't have a funding currency alternative. So a lot of what Suzuki is saying, even if he's trying to limit, you can see that by your comments that the yen's unfazed by some of this jawboning that's coming through. Really, what it needs is more decisive action. That puts a lot of the onus on the BOJ at its June meeting.
Well, Mary, the jawboning might not be working for the yen, but in China, if you can kind of call that jawboning, there seems to be a lot of rhetoric trying to support the recovery in China. We have this big fund 3, which we're going to talk about in greater detail in just a few minutes. The chip fund. You also have Shanghai relaxing its mortgage rules and property. There seems to be some momentum, but how does that equate to momentum in stocks?
Absolutely. There's been a lot of positive momentum coming out of China from officials and from policymakers. The key thing still is about the property sector. How are they going to remedy the property sector? So a few of the announcements, it's going to come down to implementation to really prop up sentiment going forward. But so far, what they're trying to say is that they're sticking to the goal of around the 5% growth target. They're trying to ensure that there is a floor underneath the economy and to push activity even further. This still still the key thing is domestic demand and consumer demand. And that still needs a little bit of work. In some of the data and some of the work that we've done, we've noticed that a lot of consumers are just piling up in savings rather than doing investing in equities. And really that the missing piece of the puzzle for a strong equity rally and a sustainable equity rally is going to come from retail investors buying into it. So there's still a little bit more to work to go, but a lot of the message that we've been hearing from authorities is pretty positive.
Yeah, that's right. Mary Nicola, thanks so much. Obviously, right now, the CSI 300 index trading pretty much flat after yesterday's nearly 1% rise. All right, well, China has set up the country's largest ever semiconductor investment fund, known colloquially as the Big Fund 3. That to propel development of its domestic chip industry. Bloomberg Intelligence Asia technology analyst Charles Shum is with us here in the studio in Hong Kong. Charles, the strategic objectives of Big Fund 3, how are they different from the previous money that was thrown at this issue?
That's a very good question. I think in the macro level, I think this is actually still consistent with the first two phases. It's still trying to build a more self-sufficient supply chain. But I think this time that will be actually the direction will be a little bit different. In the first phase that is launched 10 years ago, is looking at the building a strong local building construct capacity, and then 5 years ago, you launched the second phase. It's actually looking into building more self-sufficiency in the upstream, like the material and the tool. And this time, I think we should look into the future. What actually the country wants? I think that the term that you may be very familiarized is the Gen AI. We are seeing a lot of demand and also development in this area, especially from the recent NVIDIA's earnings result. We heard that actually there's a strong demand from each region's government to build their own AI infrastructure. I think China is also heading to this direction. So I believe that actually in this phase, actually China will try to look at how to support its local AI chips related supply chain.
So, again, you can throw money at it, but
yes.
Can we benchmark any gains at the high end? And what kind of impact will that have on the global chip market?
Yes, we should look into what it can actually get a breakthrough in the recent short-term period. I can see that there are two things that they can targeting. That is the first is the AI chips. Actually, the Huawei has quite a good progress in this area. I heard that they actually very soon will launch the third generation of AI chips. That's called the 910C. Possibly.
But is it anywhere near the H100 from NVIDIA?
No, that's
nowhere close.
That's still a bit far away. And the second thing they will probably look into is their memory manufacturing. Actually, for example, the Changxin memory, actually they are quite successful in actually getting progress in building their first generation of high bandwidth memory. This is a very critical memory part for building a whole AI training system. That's actually something that I believe the government want to keep on to build and then invest into.
Charles, David here. So I guess my next question is, by the way, before I ask the question, we were joined here, right here on set about almost 2 hours back here by the co-founder at SenseTime, and I asked him exactly about what you guys just talked about there, and he is of the view that domestic chip makers in China are quickly catching up to what you're seeing in the U.S. Although, to your point, there's still that gap, of course, that they need to bridge. So I guess the question right now, given what was announced and what we know here, how effective will this big fund actually be in achieving that goal of self-sufficiency on chips?
All right. I think it's very hard for any country these days to achieve 100% self-sufficiency. I think what China can do is actually to build some strategic advantage in some area. For example, what we are seeing that is that they're building a very large capacity in the mature nodes. Building capacity. In this area, we actually, based on our analysis, we are seeing that by the end of the 2032, it will have more than 34% capacity in the global level. That actually is the highest. That means that you will have a much more bargaining power when they are talking about negotiation with the U.S., Europe, and Japan, these advanced chip-making countries.
All right, Charles, thanks so much for your time here. Bloomberg Intelligence Asia technology analyst Charles Shum. Well, just like we were foreshadowing, up next on the China show, David mentioned SenseTime. We hear exclusively from the co-founder of SenseTime on the challenges they see facing AI firms in Asia. You don't want to miss this conversation. This is Bloomberg.
Welcome back. You're watching the China show. We're here, of course, live at the UBS Asian Investment Conference, the first one that UBS takes forward. Of course, this is an inaugural one. 27 years consecutively from Credit Suisse, of course. Now, we had different conversations here on our set here at the Four Seasons, and one of which about 2 hours back was interesting because we touched on AI with one of China's leading AI firms. So SenseTime, the co-founder Xu Bing, joined me here and set to talk us through what their goals are in terms of profitability, the timetable to which they think they'll be profitable, and of course where they think, of course, the technology goes as far as this competition is between the U.S. and China. Have a look.
SenseNova is our answer to ChatGPT, our answer to GPT-4. So we are a company of 10-year-old. We're not a new company. We started in 2014 with the help actually from NVIDIA donating 80 GPUs to us. We used to be the earliest Chinese research team that did a lot of paper on deep learning and computer vision. And we started a company in Hong Kong, and they go set up offices in Beijing, Shanghai, etc. So we listed our company a little bit more than 2 years ago. It's been 10 years for us. This year is our 10-year anniversary, and we released our newest models to compete with the best models in the world. And of course, we know that there will be a GPT-5 or even GPT-6 coming up. And we're also still trying to make usage of the resources that we have to remain catching up. So historically, during the past 10 years, we raised $6 billion in total in terms of capital. And we are a big investment. We are actually a big investor in NVIDIA chips. So we bought more than 40,000 NVIDIA chips during the past 10 years. And we leveraged those chips to train all kinds of models, computer vision models, large language models, diffusion models for generating images and videos. So we're trying to put those models into products and also release it to the industries in Asian markets.
So you mentioned a couple of things. Let me pick up on your plans to monetize them, because the competition, as we know, in China is quite fierce. Mm-hmm. Do you have any specific targets for this specific AI model, for example, or others?
Yes. So firstly, we believe that the AI represents the future for the next decade or two. The one that having a leadership in AI technology will be attracting a lot of customers to work with them. So I see that already in the U.S. A lot of customers working closely with leaders like OpenAI, like Anthropic, and I believe that in the Asian markets, there will also be leaders as well. So we try to be that leader. But of course, there are shortage of resource here in Asia in general. For instance, the shortage of compute. I think in general, it's like a 10 times of gap of the compute resources that we have here compared to the U.S. leaders. But I think Asian markets never lack of talents and never lack of data. So in terms of talents and data, I think eventually we will also be able to, even though that we have lack of compute, we're able to, make sure that we squeeze the last bit of the compute and then, try to be there.
And that is SenseTime co-founder Xu Bing speaking with our own David Ingles a little bit earlier from the Asian Investment Conference by UBS. Well, equity investors are scouring Southeast Asia for alternative ways to play the AI theme, obviously, as tech giants pour billions of dollars into infrastructure spending over the next couple of years. Let's bring in our senior Asia equities reporter, Abhishek Vishnoi. Abhishek, thanks for joining us. How much is Southeast Asia gaining, would you say, from the second-order impact of the AI boom?
Well, like you said, this is not the first-order impact. There are no chip makers or large language models in Southeast Asia. But this is possibly the best supporting cast on offer to keep the AI movie running in a way, right? I mean, you have chip testers, you have, AI infrastructure, data centers coming in. Consulting firm Kearney estimates that by 2030, why AI adoption would add about $1 trillion to Southeast Asia's economy, right? With Malaysia getting about 12 to 13% of that. And if you see in recent times, I think more than $20 billion worth of commitments have already been made over the last few months for data centers and other things related to AI as investments. So this digital infrastructure, which includes chip testers, data centers, which includes power producers, all these are set to get a leg up. And this is really important. Southeast Asia, for the most time, was a tech-less story. Even consumer tech wasn't present. But now suddenly, you're getting a lot of digital infrastructure-related plays, both in terms of foreign direct investments as well as players in the stock market. So this essentially means that, as a whole, Southeast Asia may actually get a slightly better valuation multiple over the long run.
Well, Abhishek, obviously you said, I loved how you put it, keeping the AI movie rolling. NVIDIA has kept the enthusiasm going. The stock was up at Thursday 9%, another 2.5% Friday before the long weekend. Let's bring it back to this part of the world. You talked Southeast Asia. Specifically, what are the key geographies in this part of the world, and what are the stocks to watch in this context?
I think, while entire Southeast Asia is gaining, I really feel that, data, the news, the trends, they are showing that Malaysia is actually shaping up really nicely. Right from Microsoft to Intel to NVIDIA, I think commitments of $13-14 billion have been announced over the next few years. Malaysia, like Kearney puts, can get about 12 to 13% of that $1 trillion opportunity by 2030. And this is, numbers based on right now. As things are moving, Malaysia actually maybe better poised. So in that context, Prime Minister Anwar Ibrahim is actually doing a good job inviting a lot of companies over to create digital infrastructure. And in that context, power producers like Tenaga Nasional of Malaysia, chip testers like Unisim, YTL Group, which is now an NVIDIA supply chain player, these are the stocks to watch. In other names, Thailand has Delta Electronics, Vietnam also has a stock or two, but I've never seen this kind of AI-related supply chain emerging in Southeast Asia, and in many ways, Malaysia is now pipping even Singapore. Singapore had data centers. Singapore had a few stocks related to Intel, etc. But by just sheer number of key stocks, Malaysia is way ahead now.
All right, we'll keep an eye on Malaysia, obviously, in that space. Abhishek Vishnoi, senior reporter for Asia Equities here at Bloomberg. Here are some of the other big corporate stories we are following here on the China Show. ABN AMRO Bank has agreed to buy German lender Aufhauser from China's Fosun International for around $730 million. The deal will add close to $30 billion in assets under management and $2 billion in loans to the Dutch lender's books. Now, in the latest divestment by Fosun following the sale of its stake in Portuguese bank BCP, it's also considering selling a minority holding in Belgian insurer Ageas. Now, Daiwa Securities says it's planning to hire dozens of bankers in the United States and Europe this fiscal year. Japan's second biggest brokerage wants to recruit around 30 bankers in the two regions on top of the 50 it hired in the previous year. Daiwa wants to take advantage of what it calls the good human resources shed by the world's top investment banks. That's one way to put it, I guess. A lot of human resources in bankers being laid off. Plenty more ahead. This is Bloomberg. And welcome back to the China Show. Much of South and Southeast Asia have been sweltering under a severe heat wave, one that has caused power outages and deaths across the region. It's a problem aggravated by a changing climate and poor urban design. Bloomberg's Paul Allen has the more.
Now, Karachi's 15 million residents have been baking in a heat wave. Temperatures in parts of Pakistan have been nudging 50 degrees Celsius. That's 122 degrees Fahrenheit. Surrounded by concrete, which stores and radiates heat, Karachi has become a giant oven.
Basically, we have turned Karachi into a concrete jungle, and I think green cover of Karachi is hardly 5%.
Hospitals have been treating hundreds of patients for heat stroke, keeping them cool made more difficult by frequent power cuts as the electricity grid buckles under the demand. It's a crisis that ignores borders. In neighbouring India, rivers in Maharashtra state are dry, wells are running on empty, and farmland is parched. The only point in pumping this well is to illustrate how nothing comes out of it. A typical farm worker here earns about $4 per day. At the moment, all they can do is helplessly watch as crops die.
I will not allow my children to join this profession because I believe farming cannot be enough for our monetary survival.
The brutal conditions are being felt in much of Southeast Asia as well. Rice planting in Thailand and Vietnam usually starts in May. A water shortage is stalling that, and is part of a longer-term trend.
The next 2 decades where the temperature will be increased around 1 up to 2 degrees Celsius. The rice production will be dropped around 10 up to 13%. Thailand will be export less amount of food to the world market, and that will have the implication to the global food security.
India, Pakistan, Thailand and Vietnam are the world's top 4 rice exporters. The parts of the world dodging this heat wave now may not dodge the consequences of it. Paul Allen, Bloomberg.
Well, China is spewing less carbon into the atmosphere for the first time since the pandemic ended. That's according to data from research firm Carbon Brief, and it's a sign that emissions from the world's top polluter has peaked, perhaps, before its own deadline. Record wind and solar installations have met nearly all of China's increased demand for power. The slowdown in the property sector also helping reduce emissions. Wow, good news on the climate front. See how long that lasts, though. We have plenty more ahead. This is Bloomberg. And welcome back to the China Show. You're looking at the Imperial Palace in central Tokyo. It's 11:29 a.m. in the morning there in Tokyo, 10:29 here in Hong Kong. Japanese markets are going on break in a minute, and they're trading fairly down. It's a muted day across Asia for the most part. The Nikkei 225 down about 0.3%, and the broader topics also down about 0.25% or about 0.2%. All right, Avril Hong is watching it a lot closer than I am. Let's get over to her for a market check. Avril.
Yeah, just taking another look at what we're seeing across assets in Japan. As you say, it's a pretty muted picture across Asia Pacific, but the Nikkei, the topics, they are underperforming. I think it is that expectation that we're going to get those hikes from the BOJ. It's not just from comments from the governor and his deputy earlier in the week suggesting moves in that direction. It's also data today, services PPI, higher than expected, and showing that inflation is broadening out. So there's not much gain to speak of among Japanese equities. The growth stocks not doing so well, especially on a day where they're not getting the typical direction they get from their US counterparts. Value names, though, worth highlighting, are faring pretty well. If there are those rate hikes to come, your materials, your banks, those typically fare quite well in such an environment. We're looking at dollar yen still sitting below the 157 level, pulling away from what is thought to have prompted intervention roughly at 15752 level. Something else worth highlighting as well, amid the expectations of BOJ rate hikes, we've really seen those yields go up, especially on the 30-year. In China, the dynamic is different. We're expecting easing, those yields there coming down. And the spread between them on the 30-year, that's narrowed, the tightest in 15 years. Technically, this should be good for the Japanese financial names, not so good for the China ones. Let's flip the board again as I talk to you about that dynamic. Something else that we're watching in stock movers today, Toyota, the big drag on the MSCI Asia Pacific, the tech names in China doing well. It's very sentiment driven, I think, getting a bit of a tailwind from those property easing measures. But Alibaba, something else we're highlighting before I toss you back to David as well. We're seeing that profit beat really lifting the stock today. David.
Yeah, okay. April, thank you so much for a market update there. So we've had several conversations, not just in the last hour, certainly the last few days or so, on inflation. Of course, as April was pointing out earlier on in the show, one of the core data points this week, key data points this week, to rephrase that, is core PCE, right? And certainly the difficulty to take it down that last mile. Perhaps one of the perfect people to talk about this last mile and where we go from here in terms of monetary policy. Do we need to be more restrictive is a key question here. Olivier Blanchard joining us here on set, of course. It's no need for any introduction, of course. But thank you for joining us.
Pleasure.
You co-authored a paper with former Fed Chair Ben Bernanke.
Yes.
And correct me if I'm wrong, my understanding is wrong here, but you think that the labor market is still fairly hot.
Yes.
That policymakers need to lean in to cool the market even further.
I think the answer is probably.
Okay.
So there's a better scenario, but what has happened is most of the inflation on the upside and the downside had to do with price shocks, right? First, increases in the price of energy, food, supply disruptions, and most of the decline had nothing to do with monetary policy, just had to do with the fact that, food prices stabilized and energy prices decreased and so on. So most of the action has had nothing to do with monetary policy. But as the shocks have faded, what is behind, which played a small role throughout but is now big, is the labor market. And the fact that we have a fairly tight labor market, and the fact that there has been inflation, the fact that the labor market is tight, has led to wage inflation, which is a bit too high. Too high in the sense that if we stay at that rate of wage inflation and productivity growth is normal, then this implies price inflation above 2. So the question is what happens now, right? And you can look at the details, but the fundamental issue is, I think, productivity growth. So the good news is that productivity growth has been fairly high, which means that for a given wage growth, price inflation can be lower.
Yes.
So if productivity growth continues to be strong, then we may be able to actually achieve a 2% target or 2.3, or very close to 2, without having to tighten the labor market. If not, then that's the last mile. That's the Fed has to increase unemployment, or unemployment has to increase by itself if private demand is weak, and then we need a bit more unemployment for some time. I think the most likely scenario is we need a bit more unemployment. The labor market is a bit hot, and we need to slow it down a bit, not a whole lot. So I don't think the last mile is not incredibly hard to do, but
it's the stickiest part.
It's the stickiest part. Yeah, what we got so far, the big decline had nothing to do with monetary policy.
Tell that to your friends at the Fed.
They accept that. No,
right.
Let me say something on this, which is one characteristic of what happened is that we had these price shocks, but their effect was very transient. Each shock had an effect, but the dynamic effects were very small. Now, this is where they can take credit, because the reason for this is that inflation expectations remained extremely anchored So people would see an increase in the price, but they thought, oh no, we're going to go back to 2%. And so we didn't have what we got in the 1970s, which is a wage price spiral. So, and that comes from the credibility of the central bank. So you have to give them credit for that. They used the capital, the credibility capital that they had in order to limit the effects of the shock. But in this inflation episode, the tightening of monetary policy has not played a major role yet.
Well, is credibility the reason, mainly the reason, to rephrase that, mainly the reason why we should not even consider, or they should not even consider raising the inflation target? Because that's one way to get there. That simplifies the economics. But so, conversations around, is 2% the right target?
So, I'm known as having argued that we should have a higher target for inflation. The argument was that if we have a higher target for inflation, we will hit the zero lower bound less often, which would be good. Is it the time to change the target? No. Credibility is the issue. At this stage, they have a job to do. They have said we're going to 2. I think they have to go to 2. Because otherwise credibility would be shot.
Okay, understood.
Right? So, but once we're at 2 or close to 2, maybe we should put it back on in the discussion.
Okay, once this story goes away, once the dust settles.
Once they have won their fight, they can say, okay, we won that fight, maybe the next fight should be a bit different. But yeah, if they don't do this, sorry about that, then they would lose credibility. They cannot do that.
Well, we're moving up against almost a full year now since the last hike, which was in July of last year. And the recent minutes suggested that they're even considering, to your maybe suggestion, higher rates might be warranted. What does that tell you about a year into the last hike, since the last hike, that we don't know where the data is going? Does that tell you anything?
We don't know where the data is going. And, the economy has been surprisingly strong. Now, it doesn't mean monetary policy doesn't work. It just means consumers are happy and they spend. Investment is strong because of the Inflation Reduction Act. So we're in an environment in which it looks as if demand is sufficiently strong that it's not the time to decrease rates. It's indeed maybe the time to increase them, and I give some probability to that. And I think Powell is doing the right thing, which is, every month we look at the numbers.
Okay.
I think it's still the case that interest rates should come down sometime this year, but there's a wide band, and it's not that the Fed doesn't know what to do, it's that nobody knows, and just there's uncertainty about the strength of private demand.
Is that simply a Fed issue, or do you see that issue as something that dominates conversation, say the ECB, for example, which they look to be cutting rates next week?
So the principle is the same. What you do depends on the strength of private demand. If private demand is very strong and you want to slow down the economy, you have to increase rates. But the situation is different in Europe. Demand is much weaker and is going to get weaker because in the US you have very generous fiscal policy, to put it mildly. In Europe, we're going to get fiscal consolidation. So you have weak private demand. You don't have the same investment boom. You have fiscal consolidation. So private demand is going to be weaker in Europe, which means that it's fairly clear that the ECB has to decrease rates. It's the same reasoning, but it's not the same environment.
It's not the same economy.
It's not the same economy.
Let me ask you about China since we're here, because they have an opposite problem, the lack of inflation. And to your point, the fiscal generosity coming out of the Americans, for example, we're starting to see Beijing and the central government take up more of the fiscal push, if you will. What's your sense of why there is no inflation in China? Is that cyclical? Is that structural? And what do you think is the policy prescription?
I think the honest truth is there are things that I don't know. This is one of them. So on fiscal, I think that they are doing the right thing, which is being willing to solve the real estate crisis by putting a lot of money in, but at the same time trying to be more responsible at other margins. Not knowing much, I would basically think that the low inflation reflects weak demand.
Right.
And that's, but again, I'm not an expert, and you should ask somebody who actually knows better.
Fair enough. You can't know everything. What do we talk about Japan? The BOJ.
Yeah.
Do you understand that? Do you think they understand the inflation dynamics? I don't know, because they're being asked by private economists to hike rates for the currency, really. And I'm wondering whether the underlying economy justifies more hikes ahead.
So Japan, I know a bit better. So I will try to answer your question, which is, I think Japan is returning largely to where it was pre-COVID, which is weak private demand. And then the question is, what do you do? You cannot increase rates very much because you would kill demand. You cannot decrease deficits very much because it would kill demand as well. So they are there. So they keep rates very low, which I think is the thing to do. This has led to a fairly sharp depreciation of the yen, which for them is good news, right, given that they want to increase inflation. So I think for the moment they are doing what they can do. It's not ideal, so it's still very low rates, more inflation, which in the case of Japan is good, but demand is still weak. And
well, is there such a thing as a currency that's too weak? I mean, the yen has gone from 100, let's say, to about 160.
Yeah, no.
On the exchange.
It clearly has had a major impact, and that's going to help Japan both at the the competitiveness margin and at the inflation margin. They need both. So for the moment, there's such a thing as probably too much, but I think this is big, but maybe not too much.
Okay.
I mean, they think, they're intervening in the foreign exchange market, so they don't want it to go to 200. But my sense is this large devaluation is actually a good thing for Japan. It cannot last forever, but for the moment, I think it gives them something to increase demand.
Mr. Blanchard, that's all we have time for. Thank you so much for making the time, of course. Guys, Olivier Blanchard there, Peterson Institute for International Economics, Senior Fellow, and also, of course, the former IMF Economic Counselor Director of Research. Right, Steve, back to you.
Thank you.
All right, great stuff, Dave, from the UBS Asian Investment Conference there at the Four Seasons in Hong Kong. Let's go to Taiwan right now. Live pictures from Taipei, where protesters are gathering as opposition lawmakers, I'm talking the KMT and its partner, the TPP, try to push through legislation effectively curbing the authority of President Lai Ching-te. And as you see, there's the protesters happening inside the Legislative Yuan. The session had begun to discuss opposition efforts to pass the controversial bills aimed at expanding Parliament's oversight of the government. The concern by these protesters is that it could undermine the agenda of the newly inaugurated President Lai Ching-te. We'll be coming back to Taipei throughout the morning. Plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. China AMC CEO Yimei Li here, says it's difficult to build an ideal index for Chinese companies than it is actually for other markets. When you look at, say, an example like the United States. Now, we spoke to Li exclusively for our Tiger Money podcast, of course, episode 2, and she shares her views on indexing, that elusive China index, and of course, among other things as well. Have a look.
It's always fun to look at, like if we do enough in certain areas, if we are more pinpoint in certain asset classes. But now I think one of the priority we are looking at is how to create an index that really can reflect the new China, especially the China's, advantage in economy. So that being said, I think we are currently not just on our own, we also cooperate with the index company in China to see if we can create something like China version of SP 500, which not only have the element of capitalization in selecting different stocks, but also have the fundamentals going into our process so that we can pick the best in kind.
I'm wondering, and I know you guys are still contemplating and experimenting what an index might actually look like. Just give us a sense what you suspect that eventually looks like. Is that purely onshore stocks? Is that an index of 500 names, for example? And we won't hold you to it. What do you think that might look like in the future?
For me personally, and this is really not the official version, but for me personally, definitely I think it should at least combine what's in the Hong Kong stock market. And it really goes back to the fundamental question why people invest in a broad index, right? So you invest in SP 500 to really reflect, the whole U.S.
You're buying the U.S. economy.
If you want to buy U.S. economy, you go to SP 500. So that's your, ultimate solution, right? So when we look at China and what represents China's economy, frankly speaking, in the past 10 years, the best companies in China, most of them are not listed in Asia. So I do think we really need to incorporate what is the best in China. When you invest in China, you want to invest the best companies in China. And then what's the criteria to combine value and growth? Because it's not going to be just the value or just growth. So I think this is hard, and it's not probably going to be successful for the first attempt. But we will keep digging and keep using our active fundamental analysis to try to picture what we think will be the best way to, show China to the whole world.
Well, that is China AMC CEO Yimei Li with our China show co-anchor David Ingles and Bloomberg Intelligence ETF analyst Rebecca Sin on the Tiger Money podcast. You got to check that one out. And you can find new episodes every second Tuesday on Apple, Spotify, YouTube, and Bloomberg.com. Plenty more ahead, including the China Brief. We're going to do a roundup of what's hitting the front pages of Chinese newspapers on the mainland. Plenty more ahead. This is Bloomberg as we head into the final stretch of the China show on this Tuesday. All right, welcome back to Bloomberg, the China show. Here's your China brief and look at what's making headlines in national newspapers on the mainland. The front page of the People's Daily is all about President Xi's directives at the Politburo meeting yesterday, Monday. Among them, promoting the rise of the central region, particularly 6 provinces through the central belt of China, with an emphasis on the area's role as a key grain and modern equipment manufacturing hub. The provinces of Shanxi, Anhui, Jiangxi, Henan, Hubei, and Hunan were singled out and ordered to work together. Now, the paper also carries a piece on the trilateral summit between China, Japan, and South Korea that wrapped up in Seoul on Monday. It calls on the 3 countries. They should finish negotiations on a trilateral free trade agreement as quickly as possible. Over at the Securities Daily, they're reporting that banks are intensifying a so-called loan price war, with consumer rates slipping to as low as 2.8%. The article also notes that mortgage costs are currently not high as banks slash rates for the first home buyers in a bid to boost the property sector. And another report in the paper saying 35 companies have withdrawn listing applications since the start of this month. That's after they did not meet the new IPO standards, which include heightened scrutiny of financial indicators. And speaking of regulatory scrutiny, the 21st Century Business Herald says some local securities regulators are asking listed firms to report their use of raised funds. It quotes unnamed sources saying the investigation targets not only proceeds from IPOs, but also those from private placements and convertible bond sales. All right, let's go over to our expert standing by at the Four Seasons Hotel. Real tough gig there today, Dave, at the Four Seasons, but great guest. What stood out to you?
Yeah, we are absolutely roughing it here, as they say. There are very few instances, and I'm sitting here at the Four Seasons at Central Hong Kong, where I'm thankful I actually went through some hostile environment training. Really sets you up nicely for coverage like this. That's banter, of course. But a lot of tough conversations, I guess, if that's one. One of the things that we did manage to talk about with the UBS Asia Pacific CEO is, well, for one, the conference, second, really where they think the business will be, where the bright spots are, but also where they are as far as this transition goes, right? So, this time last year, they took over Credit Suisse, and I think he mentioned earlier on that in a couple of days, actually, they will be completing that as far as the folding that it is concerned, and they're almost done with the job reductions as far as that conversation goes. A tough conversation certainly around headcount reduction. We've had some conversation on AI, and in the next hour, of course, of the show here, we'll have two more interviews coming up. We'll talk more about particularly India. It's going to be very much in focus. The keynote speech earlier on was from former RBI Governor Raghuram Rajan, who will be joining us here in about 10 minutes or so. So stay tuned for that interview coming up. All things India, the elections, what happens to this infrastructure push. Can India afford it? Is that sustainable? Does that put the credits profile at risk? So, yeah, stay tuned for that interview, plus, of course, the open of markets there. And as we wrap up the big market stories of the day, that's it from us here at the China Show. Bloomberg Markets Asia is just ahead. Stay with us. You're watching Bloomberg.